Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten. Today, I am joined by Amarie Rogers. Amarie, welcome to the show. She's with Inspira SDIRA. Amarie, tell us a little bit about yourself and what Inspire is doing today.
Yes, well, first, thank you for having me. It's always a pleasure to be having the opportunity to talk about my very favorite topic of self-directed IRAs. I've been in the self-directed industry for 12 years now. Previously was with Quest Trust Company and then now work with Inspira Financial. And Inspira is really unique in the space. We specialize in alternative investments and self-directed retirement accounts where people can choose for themselves what they want to invest into and be able to not only do alternatives, but also be able to do traditional investments. But we also do a variety of other things. So we do 1031 exchanges. We have a health side of the business, benefits as well. So Inspira does quite a number of different things and is pretty large. They have about 62 billion under administration and around 8 million account holders. So definitely a powerhouse and kind of a holistic financial wellness company.
Well, that's amazing. And thank you so much for kind of clarifying what Inspire does today. Now, here's the reality. A lot of people, there are tons of webinars out there on self-directed IRAs,
That's
and
for sure.
there's a laundry list of how to open your account, how to transfer your money. But what I want to help people understand is that the reality is for many investors, they have hundreds of thousands of dollars, sometimes millions, sitting in retirement accounts that feel locked up until they're 59 and a half.
Yeah.
The question that I want to dive into today and really dig into is not so much what the SDIRA is, but the real question is how do I unlock the capital so it's working for these investors today, growing strategically and still staying protected by the IRS rules? So that is what I want to focus our sessions on. Well, as always, keeping on brand, we're going to keep it simple. So my first question is, maybe for somebody who already has a traditional IRA or 401k, what makes the self-directed IRA different and why should an accredited investor actually care that the self-directed IRA exists?
I mean, I think it's important for any investor to be really mindful that you are building your portfolio and that you are thinking strategically and always taking advantage of the newest available opportunities for you in the space. Um, I actually have a few metrics that I'll share in IRAs in the United States as a whole. In IRAs, there's $17 trillion. So it is a huge, huge source of capital. But only about 5% of that is being self-directed. And so why is that? I think the biggest driving factor behind why there are, so few of the 17 trillion dollars that are being deployed into alternative investments, it's because your big name financial companies, where I'm sure many of the listeners today may already have a retirement account, those companies, they do a great job, but they exclusively deal in the publicly traded side. So they're doing the stocks and the mutual funds and CDs, and that's what they specialize in. And so that's what most people end up investing their retirement account into. However, by 2029, it's estimated that of retirement accounts, assets, about $660 billion in the United States is going to be in alternatives. It's a rapidly growing and evolving type of investing. And I think it's such an important thing for people to be adding into their portfolio. And it's not to say that you're going to completely leave mutual funds or CDs, behind. There's absolutely a place for that. And I'm a huge advocate that people are really having that diversification. Like you don't want to have all of your hard-earned money in just one specific type of investment type. But I think where sometimes investors are missing it is that they think that they have this diversification because they're like, okay, well, I've got some stock investments and I've got my mutual funds and I've got my bonds and I've got my, annuities and I've got some CDs and I've kind of got a mixed bag of things, in my account. But I would argue that if you don't also have your alternative assets, your things like real estate, your things like maybe passively investing into a syndication or investing into a private company, then I would argue that you really are just dabbling from an investment standpoint in just one side of the house. And so, when we think about the power of self-directed IRAs, obviously the biggest piece of that is that, you get to invest in alternatives. But the other, kind of secret weapon is that it's self-directed. So if you're the type of person that's entrepreneurial and you like to educate yourself and you are good at making savvy, investment decisions, then that is your secret weapon. In a self-directed IRA, like you're the one that's choosing the investment. It's not me. I'm the custodian and I hold the account and I help you to process the investment once you've identified it. But in a lot of instances, you know what you want to invest into. You're pursuing becoming knowledgeable about it. So why not take that step to do the investment in a vehicle that's then going to also afford you that type of, tax advantages that you get when you use these types of accounts. And that's really the whole reason why people are doing it, is because they get the autonomy over what they're investing into. They're getting the diversification. And of course, they're also getting all these great tax advantages. So, kind of makes it a no-brainer once people really learn about it. And I think that's why it's, in my 12 years, why it's gone from 2% of people in, the United States that are doing this to 5% of people. And it's always increasing.
Well, and I love the fact that you touched on alternatives as, the ability to invest in alternatives is really what makes the SDIRA shine. And one of those alternatives that we love here at passiveinvesting.com is real estate, right? Like you said, you can do businesses, we do express car washes, you can do real estate, you can either buy your own rental or you can invest in a syndication that actually where the operator is running the rentals for you, whether it's self-storage or multifamily. Now, what I just mentioned a few things that can go in there, but what kinds of real estate investments can be made within a self-directed IRA? And more importantly, what are the restrictions that investors need to know about upfront?
Yeah, I think when people think investing in real estate, um, I think the mind often initially goes to, okay, I can take the funds and I can go and buy a residential property and I can be a landlord and put renters in the property, or, I can be Chip and Joanna Gaines and I can make it beautiful and I can flip it, right? I think that's kind of like where the mind typically goes to first. And it could be both of those things. But for the majority of people, I think it's often something a little different. And so when we say real estate, there's so many different ways that you can get involved and do a real estate investment in an IRA. It could be buying a residential property and putting in renters, or it could be improving it and then selling it at a profit. But it could also be investing completely passively in real estate. And that real estate might be doing something residential, or perhaps you're investing into commercial or multifamily. We, like you said, we see a lot of investors that they will perhaps invest into a fund that is, either buying new or buying old multifamily properties, or that they're building, new multifamily properties. We see people that they're investing into more like a self-storage or car washes. One that I heard recently was someone that's they're investing into the industrial space, and so they're investing into like warehouses. So I think that there's so many different ways that you can go with it in real estate. It's not like a one size fits all. You don't have to be a landlord. You can still make great returns and just, deploy your IRA funds, and maybe over the course of 5 to 10 years be in a fund that, you're making great returns, but you're really not having a heavy lift where you're having to actively manage real estate. And so I think that is probably the most common way that we're seeing people get involved in the real estate space, because chances are many of you might have a 9 to 5 job and you're busy, and so also having real estate properties that may or may not align with your goals, but there's still ways to be able to get the great returns from real estate without actually having to go and swing the hammer or manage the real estate yourself and vet the deal and all of the many things that come associated with that. In terms of what restrictions exist, so there's really a few things to be mindful of. You, as the account owner, you're considered what's called a disqualified person. And really, anyone in your immediate family is also disqualified. So think your spouse, your kids, your parents. And so there's some really specific things that these people are not able to do as it relates to the investment in your IRA. And so some examples of that would be, let's say you bought a residential property, you can't get some type of personal benefit from it. So your IRA can't buy a property that you then go and rent out to your kids, or you couldn't fix up the property yourself. Kind of, you want to think about when you're doing investments in your IRA that everything that you're doing is for the benefit of the IRA. You're not getting some type of personal benefit back as it relates to the investment that's in there. So I always like to say to people to, before you start pursuing investments, like give us a call. We have a team of IRA specialists, many of which are certified through the American Banking Association. So, they're highly knowledgeable in these rules. You don't have to be the expert because we are, and we can tell you from an education standpoint, like, hey, that is probably something that is typical. That's something that we often see in the account versus, hey, maybe that's something that you want to go consult with an attorney because you're kind of like walking that fine line. And so I always recommend that, give us a call at Inspira, and we can definitely help and kind of talk through specifics. But chances are, if you're investing into something passively like a fund, there's really likely very few restrictions for you in terms of your capacity, more so if you're thinking of doing something like buying real estate, as an example.
Well, and then we also have the restrictions, and correct me if I'm wrong, you can't buy art, you can't buy wine. I can understand the wine, right? Like you might drink it,
What a
right?
bummer.
Yeah, right. Stamps, collectibles, that sort of thing.
Yeah.
And then there was a case a few years ago where, it really got tested whether you can actually buy gold and take possession of that gold. And,
Yeah.
most investors are wanting to buy the gold and keep it at home or keep it in their own safety deposit box. I'm not sure where we landed on that court case, but it sounded like if you bought it through your your self-directed IRA, you might want to consider having that custodianed by somebody or
Yeah, you bring up a good point. There are some parameters in terms of the specific like investments that you can do in the account. Really, the things to be aware of is that you cannot invest into anything that's considered like a collectible. So, what's a collectible? Kind of think, is it an opinion-based valuation? If I like the house that I'm in right now. I can get a hard appraisal and we can come to, a consensus on what the value of that is or what the value of a piece of land is, for example. But something like art, something like jewelry, most coins, those sorts of things are more of an opinion-based value. You bring up another great one, like alcohol collections. My husband is a like bourbon aficionado, and so he has like a room of bourbons in our house, like not something that you can typically invest into. Fun as a hobby, probably not permissible as an IRA investment. So there are a few things to be mindful of there. Precious metals, things like gold, that's actually become a lot more prevalent over the last couple of years, and the value of gold has been going up. So we do, certainly see demand for that. I think the biggest call out that I would make is that you want to make sure that if you are investing into that, like, sometimes maybe not anymore, but maybe previously, if you're watching TV late at night, you see those commercials on TV like invest in your IRA in gold, and they'll send you the little packet and all of that sort of thing. You can definitely do that, but you want to make sure that if your IRA is buying it, like you're not personally in possession of it. You want to make sure that it's in some type of like depository or it's being held elsewhere. Because again, it goes back to these rules as it relates to you being a disqualified person, that you really can't be like holding or benefiting or doing anything associated with the investment. You want to be very hands off. So again, you'd want to store that with a depository.
Mhm. Now, the list, thank you for entertaining me, because the list of what we can do with the self-directed IRA is much longer than what we shouldn't be doing in the self-directed IRA.
Yep,
And
definitely.
you already kind of answered one of the questions I had for you was like, is it all or none or bust, right? Like you can actually hold both a regular IRA account, that's stocks, bonds, and mutual fund, and part of that money can go into a self-directed IRA. So, and we talked about what you can go into. Now, I want to pivot a little bit and talk about the wealth building part of this. And
Sure.
one of the big ways that IRAs in general, but I want to, really tap into the self-directed IRA. Like, how does that self-directed IRA maybe out edge a traditional IRA in order to help you build wealth? And then we can move into the tax part of this, which everybody loves taxes. Well, no,
That's for
they
sure.
don't like taxes. They don't want to
We
pay taxes.
like to
They like
avoid
talking about
taxes.
they love avoiding taxes. They love talking about taxes. So let's
Yeah,
talk about
yeah.
it. How does this potentially edge out just the regular, big box Vanguard, Fidelity, Schwab type IRA?
Yeah, I mean, I think the biggest thing is that, you're the one that has that financial autonomy. If I took $50,000 and I invested it into a stock, I'm completely reliant on the company performing, in that time frame that I'm invested in there. And it's not to say that I can't make a good return. Maybe I go and I invest into Berkshire Hathaway or something like that, right? Like a big name company, and I can still kind of get the play of real estate. But I'm investing into a stock. And so again, I'm completely reliant on that. And I think the flip side of that is if I took that same $50,000 and I invested it, whether I'm actually buying a piece of real estate or whether I'm investing into a private company or fund or something like that, that's maybe doing real estate, I have a lot more control over what I'm doing. I have the ability to be able to vet the deal myself, vet the capital raiser. If I'm actually buying a piece of real estate myself, I have the ability to go out and use my knowledge to find a good property and to be able to have that control over what the investment is doing. I think that is a huge factor for people that really draws them into self-directed IRAs, is that the traditional model where we see people park, their 401k and their life savings with a financial advisor, and they're like, okay, like, I'm going to retire in 30 years, like set me up. I think what we're seeing is unfortunately that some people that's working for, but for many, maybe it's not. And so they're getting closer to retirement age and realizing, hey, how am I going to bridge that gap? Maybe the market didn't perform at the level that I thought that it would, or that maybe my living expenses are higher than I had accounted for. And so I think that's drawing people into self-directed IRAs because they really feel like they can directly affect the money that they are making. And so many people, I think, would agree that real estate is an obvious, way that you can be successful and have that type of exponential growth. And so, yeah, like to your point, from a tax standpoint, like we all want to make a good return, but we also all want to make a good return and pay the least amount of taxes that I can possibly pay on them. And so if that is you, then a self-directed IRA is a really good fit for you because it's going to give you that ability to choose not only what you're doing, but then when you're making these good earnings off of it, to have it in a tax sheltered type of account.
Mm. And I love what you pointed out there is that, the tax-free growth of these accounts is what, which isn't that starkly different than, your big box self-directed
Yeah.
IRA. But that is the power of the self-directed IRA because I now, for example, I'll use me. Um, I could either go buy that piece of real estate and maybe I'm running the deal and, I can get the cash on cash and the equity growth, or if I'm closer to retirement and I just want to, go into a debt deal and get 8% or 10% return annualized and just allow it to come back to the IRA account and allow that to compound. That, if anybody has ever done you go to irs.gov compound calculator and look at just $100,000 compounded at 8% for 20 years, you'll end up with a big chunk of money. Then change that timeline to 50 years. You won't need any other investment
Yep.
because it's just a ridiculous amount of money. So, one, saving on the taxes within the self-directed IRA vehicle, but it allows you to go into assets, alternative assets that can produce a predictable, consistent, higher rate of return over what we've seen in the stock market. Now, this is not financial advice. I'm just telling you my own personal opinion and what I have done with my account. But I think that's great. And especially as you get at the higher income levels, and I would love to know your opinion, Amarie. Why do you think it's even more important that somebody at a higher income level consider doing the self-directed IRA?
I mean, I think that the biggest, consideration is that that maybe is a little bit undervalued too, is that, obviously you're thinking about for yourself, for your own future. Um, it's a retirement account, so the whole purpose of it is that you are accumulating wealth in there for you to be able to live out the rest of your days comfortably. But I think the thing that's also a little bit utilized or under discussed is also using retirement accounts as a long-term like legacy play. Thinking about it, as you're putting together your estate plan, what are you also doing to prepare to pass on that type of wealth? Because if you've done it correctly and you're investing into, these type of alternative assets, you're probably going to make a good return. You're going to be making this strong return in your retirement account, and chances are you might have money left over that when you do pass away that you're going to leave that to children or to grandchildren. And so I think that one of the things that people can be also considering from a preservation standpoint and from thinking from a tax strategy perspective is also how am I leaving that account to future generations? You know, uh an example of that is, maybe I have a IRA and it's got quite a number of different investments in there. That is money that your children could one day inherit. And that's great because it's money that, perhaps they wouldn't have otherwise had. But is it also going to be a huge tax implication for them that, over the course of several years, they're going to have to deplete that account and, potentially pay taxes on it that maybe they weren't prepared for. And so I think one of the things that especially high earners can be considering is also some of the advantages of using a self-directed Roth IRA and potentially look at strategic timing that you want to consult with your, CPA on to make sure that it makes sense. But think of strategic timing that you could be converting over either cash or assets over into a Roth IRA so that when you are leaving this wealth to future generations, that they're not inheriting a large tax bill, that they're inheriting a tax-free bucket of money that they're able to draw upon when they do inherit that. So I think for our high earners, for people that are really thinking more on a long-term perspective, I would encourage people to be thinking about a Roth IRA. And there's often a perception that Roth IRAs are only for this person or this type of person, but anyone can have a Roth IRA. If you are a high earner, you probably can't directly contribute to it because of your high earnings, but you can convert existing money in a traditional IRA or in a 401k into that type of account. And that I think is a huge, huge play that we don't talk about enough in the industry. We just talk about the fact that you're able to leave this wealth, but take that a step further that you're leaving your children and grandchildren tax-free wealth. That to me is a huge play.
I have a couple questions, follow-up
Yeah,
questions.
sure.
And I'm gonna, okay, the first question is if that, you know, I pass away, my IRA, self-directed IRA accounts, I guess my husband has to pass away too. Sorry, guys, morbid conversation, but they go to our daughter.
Nobody wants to think about it, but I think that it's something people should think about. Just like you're thinking about your
Absolutely.
will, why not?
Okay, let's just pretend everything goes to our daughter. Our daughter, how long does she have? Because you touted the Roth IRA, and I know that
Yeah,
was changed in the past couple of years. I think it was with
it
the
has.
SDIRA 2.0 Act. With
Yep.
the traditional IRA, wouldn't she have like X number of years in order to get those assets out? But with the Roth IRA, do they all stay in, or does she have to also take required minimum distributions as well?
Yeah, so when I first got started, we used to talk about the Roth IRA because you could essentially leave it in there for the full lifetime of the person that inherited it. But yeah, you hit the nail on the head. So a few years ago, with legislation that was passed, there were some caps put on that. And so it's 10 years. It's 10 years. So at the end of the 10th year, money would have to be, essentially the account would have to be depleted. And so when you think about that from the standpoint of, hey, you're inheriting that and now you've got to deplete that account over 10 years and potentially pay taxes on it, that could be, again, it's money that these individuals didn't have, but it's money that they're going to have to also be prepared to pay taxes on too. So in the Roth, yes, they still have to deplete it within the 10 years. However, it's going to be tax free.
And in the traditional account, it would then be taxable income.
Correct.
There's one other like little nugget in here, and this is something that I'm constantly having conversations with investors about, because they'll push back on me and they're like, "I hear you. Investing through a self-directed IRA account sounds fantastic until I have to start taking required minimum distributions, and then I have an asset and no cash."
Yeah, that's a good
Tell
question.
us, how does that then work?
Yeah, so if someone came to me and they asked me that, my first thing I would tell them is, do you have an IRA somewhere else? Because if the answer is yes, then I would satisfy your required distribution from another account. It can't just be any account, can't be your bank account. It has to be another IRA. But as an example, if I have a house and all my money is tied up in a house in my self-directed account and I had no cash in there for whatever reason, if I have an IRA at Charles Schwab, and that's just invested into stocks, and I can immediately sell off, whatever, $2,000, let's say, is my required distribution amount. I can sell off $2,000 worth of my stock investments and distribute that in, 24 to 48 hours or so. Then that to me is the easiest course of action to satisfy it. If that isn't an option, then I mean you could pursue other options like you could technically distribute part of the asset to yourself to satisfy it. Obviously that, you're starting to get a little bit more complicated and that certainly isn't the ideal situation. The easiest thing is to be mindful of it on the upfront. If you don't have another account elsewhere, then don't tie up every cent in an asset that is not easily liquidable, right? Leave whatever, 5,000, $10,000 that's not invested in case that you would need that money. But, again, for most people, their self-directed IRA is probably not their only account, or they're not going to move all of their money over and invest it. They probably have money elsewhere that they could just take care of it, and they just might not be aware that they can, satisfy it from another IRA at another company.
All right, I have kind of like a little bit still in the wealth building in front of this. What are the main risks or costs that accredited investors should weigh before opening a self-directed IRA account? Right? We talked about how cool this tool is for building wealth and even passing wealth on to the next generation. But what are some of those upfront decisions they need to have weighed?
I mean, I think from a custodian, I'll kind of speak to two sides. I think I'll talk from the custodian side and then also maybe the investment piece as well. From the custodian side, I mean, I think that you want to make sure that the company that you're working with that they have competitive fees and good customer service. At the end of the day, it is self-directed. So you're probably more likely to engage with your self-directed custodian than you might be if you were investing at Charles Schwab and you're buying a stock and, that's kind of it until you're ready to get out of it. And so I think thinking about it from the good service and the, fee standpoint, those are a few good jumping off points for sure. From the investment piece, I mean, I think we hit on one of the maybe cons or considerations of a self-directed IRA, which is a lot of times these investments are not as easily liquidable. They're not like a stock where you can kind of snap your fingers and get out of it if you need the money or want the money. It takes a little bit more legwork. Like maybe you're in a fund and there's not an exit point for a few more years, or you're in a house and that requires you to sell the property or sell a portion of it. So I think there's things to think about from that standpoint. The last, I think I would share on that is also from a standpoint of if you are investing passively and you are pursuing investing with a syndicator, you really want to make sure that you're investing with a company that has a proven track record. And I think now more than ever, it is critical to be very, very mindful and doing due diligence. And there are so many good resources out there. It doesn't require, necessarily like you having an attorney to review the investment documents, though you could certainly do that for some good peace of mind. But I think that would probably be the biggest thing that I could say. Because if you've been doing this for long enough and you are investing with syndicators, chances are you're gonna see some that the investment goes south, and you don't want to be in that category. So thinking on the upfront about who you're investing into and making sure that this is a good quality deal and a good sound company that's making strong investment decisions with your money. I think that to me is the biggest call out that I would make to investors because I mean, like I said, if you've been doing it long enough, like we have, like you're probably going to do a deal and it's probably going to, go south. And that is your hard-earned money. And you want to make sure that that doesn't happen. And that's probably one of the things that people don't talk about in self-directed, because as a custodian, like we want people to do alternative investments and we want them to invest into these type of assets. But I don't think we can talk about all of the good things without also talking about the fact that you are investing into private companies and you need to protect yourself because it is your retirement and it is your hard-earned money, and you want to make sure that you're investing it in a with a good person in a good deal.
No, I couldn't agree more. And, to actually expand on that, I mean, even if you're buying your own particular real estate, I always say it's not a matter of if an investment is going to go sideways or south. It's a matter of when, right? So we always, always, always do your due diligence. So, we all know the environment has been extremely challenged in the past 2 to 3 years, and great
Yeah,
operators have had challenged deals. I think the where I want to take this one step further is making sure that the fundamentals of the company are not based on fraud or Ponzi schemes, and that's huge. And honestly, I've gotten several questions in from investors, not today, but in other episodes, where I'm actually putting together a webinar to help lead investors through, like, what to believe in today's environment. Do I believe what's posted in the investor, all the millions of investor groups that are popping up? What can I believe in the headlines? Heck, what can I even believe from AI? And so, again, I love the fact that you brought that up. Um, but I think even we got to peel back the layers even more and like look at the fundamentals of the company and how it's running. I mean, even Berkshire Hathaway and BlackRock, like they all have like investments on their book that have gone sideways and south, but
for
they're
sure.
fundamentally strong companies, and that's what we want to focus on for sure. Um, Now I want to pivot to the how and then wrap up with some questions and with maybe a couple scenarios that people have written in about. Um,
Yeah, of course.
let walk us through. Okay, somebody's sitting here and go, Amarie, that sounds amazing. I want to learn more about self-directed IRAs, but I've heard this takes a really long time to get set up. Walk us through the process and where Inspira gets involved.
Yeah, I mean, I think the biggest thing I would want for people to know is that it's really a very simple process. And sometimes I find that people that are just learning about it, maybe alternative investing is new to you. And so then adding in self-directed IRAs, sometimes that feels overwhelming to people. It's like, this is I know what an IRA is. I've had my 401k for 20 years, but the self-directed piece kind of adds that, new element to it. And so I think what I would want people to know is that it's really very simple, and it's important to have a company like Inspira where we have dedicated relationship, managers that are there to explain to you from start to finish exactly what, you need to do. The process to set up the account is simple. I mean, it just consists of an application, can be completed online and takes about 15 minutes to do that. But I think even beyond that, it's also having that person that and you can call and it's like, hey, I'm considering doing this deal. Can I do that in an IRA? What is the practical application? How do I do it? And having that like one-to-one relationship where, it doesn't just feel like you're going on the website and filling out the application. It's like I'm filling it out, but I've also had that conversation and feel equipped that my questions are answered and I have the resources to make those good decisions too.
Awesome. All right. I want to make sure that we leave time for our Ask Me Anything part of the show. But as we wrap up with our main part of the show, if you're an accredited investor listening today, what's the single most important thing that they need to consider when deciding to use an SDIRA for real estate?
I think the biggest considerations are, do you have accessible money that you can be using? We often will get people that will come to us and say, okay, I'm ready to move over my 401k for my job. Probably can't do that because your 401k is likely tied up until the time that you would leave. So I think that's a big one is, do you have accessible money that you can move over? So a 401k from a prior job, an IRA, a Roth IRA, were you self-employed and you had a SEP IRA or something like that? Those are going to be accessible for you to immediately move over and deploy into a deal. And then the other one is, do you have a deal in mind? At the end of the day, the people that are most successful with self-directed IRAs are the people that have a little bit of that entrepreneurial spirit and that have identified an investment. Because I mean, you can certainly come to Inspira and put your money and you will earn some interest off of the money that just sits here while you're looking for a deal. But at the end of the day, it is self-directed. And so you've got to connect the dots and you've got to find that investment to be successful with this.
Well, awesome. Amarie, where can people connect with you and learn more about this?
Yeah, people can connect with me in a couple of different ways. I'll actually put my email address in the chat here. It's Anne Marie period Rogers. So it's ANNEMARIE dot Rogers, ROGERS at inspirafinancial.com. But if people want to connect with me directly, I'm happy to be a resource and help answer any questions. We also have a great panel that's coming up in exactly 1 month, actually, from today, where Whitney will be participating and we'll be talking all about passive investing, investing into multifamily specifically. So would love to have everyone attend, and I will include the link for that as well for everyone so that you can go ahead and register. And whether or not you can attend live for that one on the 30th of October, you will get the replay. So go ahead and register and you can watch it in your free time as well.
Awesome. Well, guys, I just want to let everybody know that, the difference between being somebody who's curious about self-directed IRAs and saving money in an SDRA versus being a wealth builder isn't just about knowing the SDRA, but using it as a part of your broader wealth building strategy to build, protect, and to grow your wealth and pass it on. Now, for those of you who are live, don't go anywhere. We're about to start the Ask Me Anything part of our show. All right, I'm gonna get a big pause there. All right, I'm actually gonna record this because our team might actually keep the questions in. We have a lot of great questions in the chat. Um, So somebody joined late and said, sorry if this was addressed. Can you go into how do you use self-directed IRA funds to privately lend money or do hard money lending? So they're not lending to themselves, they're not giving it to a syndicated deal, but how can they do private money lending in their self-directed IRA?
I love this. I'll speak from personal experience. I love this as an investment. My husband and I have done many, many private lending deals. It's probably my favorite type of deal to do personally. And I'll tell you why. For us, it lets you build a relationship with someone and get to know them and have a lot more direct oversight over what the investment is doing. And so for me, I really like that. I want to kind of like feel like I have the control and that I have the, whatever monthly updates and I see the monthly interest payments coming back in and I kind of know the health of the deal and that lets me sleep a little bit better at night. And it is very passive and, we both travel a lot for work. And so from the passive versus active investment perspective, passive will always win for us because we've got a busy lifestyle. But I mean, yeah, that's a really common one that we see. It is all privately negotiated. So, if you've got several hundred thousand in your IRA and you want to lend it out to a real estate investor, you guys negotiate all the terms of the deal. So, what's the length of time for the note? And what's the interest and what are all the terms of it? And the other big thing to consider is that, if that's a secured investment, then it also gives you a little bit more of that protection from the standpoint of if for whatever reason, God forbid this happens, but if for whatever reason the person that you lent the money to doesn't pay back your IRA, you also have recourse in the sense that if you lent on a piece of real estate and the loan is secured by real estate, then you have that as the collateral that you can obviously take ownership of. And so for me, I really like that as an investment. And chances are, and again for me, like we have relationships with a few people that we know that they are successful real estate investors and their entire business model is that they go and buy these properties is based on getting private money. And so it's really easy for us to be able to find new deals because we've already done a good one. And so then when the next one comes in and we've got money to deploy, again, it's a really, easy opportunity for us to go into. So I love it. I think it's a great opportunity. And there's lots and lots of really good education out there about, all the different ways that you can do it too.
So can you, if you charge points in origination and all your fees, so can the points for origination go back to your account?
Yes.
Awesome. Okay, a
Yep.
little boost there. And then on the
Definitely.
fees, do the fees paid have to come out of the account?
So interesting question. So I have seen a lot of times, and I'll kind of speak from the borrower perspective. If you're going to someone and you're like, hey, I want to borrow X number of dollars, you want to make that deal feel advantageous for them. And that could come in a lot of forms. I mean, obviously they're doing the deal because they want to make, good returns on it. But another way that you as the borrower could also be kind of incentivizing and sweetening the deal for them is also, do you pay the couple $100s that it, costs for the investment? So that's also something that I sometimes see people structure into the deal where the borrower will pay the lender's custodial fees. And it's no different than if you went and borrowed money from the bank or the hard money lender or anything like that. They're all going to have fees associated with it. It's probably a lot cheaper to pay the custodial fees than to go to some of those other means and potentially get a loan too. So I think that's like a small tidbit of something that you can do. But I mean, generally, you can pay like attorney fees to draft the docs, custodial fees. It would all typically come from the account or could be paid like by a credit card as well, just kind of depending what it was.
Gotcha, gotcha. I'm buying real estate using the self-directed IRA. Isn't it a significant downside is it can't take advantage of the depreciation, particularly accelerated depreciation since it's in a tax deferred account?
You definitely hit on an important point. There are certain types of tax strategies that might be available to you when you are doing the investment yourself versus doing the investment in an IRA. And an example of that is certainly like depreciation. Another one is I mentioned earlier, like we do 1031 exchanges at Inspira. Like typically there's not an ability to kind of combine those. Was at a conference, on a panel about a week ago, and the focus was on cost segregation as another tax strategy. So, like, there are different things like that you probably can't combine into it. What I would say is that when you are doing an investment, if it incurs like UBIT or UDFI, that's when you might be able to start capitalizing on some of those sorts of things. So definitely, I recommend giving us a call. Maybe we can talk specifically about if you have an investment in mind or one that you're already doing, and we can kind of dig into that a bit more. But yeah, I mean, I think that's a fair call out that there are certainly some strategies that maybe you can't necessarily combine in a self-directed IRA, but you are obviously still getting the earnings growing tax deferred or tax free. So as long as the numbers make sense, that is the primary tax advantage that you're getting from it.
Yeah, we had Tom Wheelwright on the show about a year and a half ago, and I love his book, Tax-Free Wealth. And the best way that he put it to us is you have a tax advantage account, so negative taxes, let's say -1, and then a tax advantage asset, -1. -1 times -1 is +1. Guess what? You get taxes. Now, we have a perfect segue into the next question on maybe how we can sidestep some of these taxes. However, when we talk about the depreciation, the best of my knowledge, the way my CPA has explained it to me, is that the losses get stopped at the account and they're banked there. I believe it's of talk to your accountant about filing a 990T, so essentially a tax return for an IRA account, self-directed IRA account. And so you can actually bank the losses at the self-directed account level. And then when the asset sells and say it is the self-directed IRA, which would be subject to UDFI and potentially trigger UBIT, those losses would then offset any depreciation recapture gain at the end. And then your UDF. This is why most people that are seasoned investors, when they hear UDFI, they kind of like, they're like, yeah, it exists, but typically, if you're organizing your affairs as such to lower your tax implication, which you're allowed to do, working with a good tax strategist, it's probably not as big of a deal as most people would paint it out to be. So that is something for you to think about. Amarie, do you have anything to stack onto that?
I was just gonna add on too that, we get that question often, and it's kind of funny because, when someone calls us and they're like, oh, like, am I gonna have to pay UBIT? We're like, well, hold on, like, congratulations, because you did an investment and it's making money. And so that's, it's a pretty good problem to have that now we got to talk about UBIT and some of those other sorts of things. And so I think that can kind of be like a scary topic for people or, hey, is that something that should make me hesitate to do the deal? But I think at the end of the day, a 990T is really not a heavy lift. A good CPA is going to be able to help you out with that. And in fact, Inspira has some services where we can also help with the filing and different things like that too, from preparation standpoint. So we really try to make it as easy as possible for people that it's not a scary thing like maybe I think it used to feel like to people. It's something to be mindful of, but again, it doesn't even apply to every single, person's scenario. It's really just on some specific use cases for investments in your account.
Which leads to this next question I want to ask.
Sure.
Is we talked about the self-directed IRA a lot, and then, Amarie, we can look to bring you back on in the future and talk about solo 401k. But just in a nutshell, real quick, what's the difference between a self-directed IRA and a solo 401k?
Yeah, I'd love to talk a little bit about the differences. We could definitely do our own class to talk about it. There's so much to say. I think a couple things I would want people to know would be your solo 401k and your self-directed IRA are both a do-it-yourself type of account. The difference is with the solo 401k, it's completely do it yourself from all aspects. When you're investing in your self-directed account, you're choosing the investment, but from a purchase standpoint or from paying expenses standpoint or receiving profits back, we're doing everything. We're facilitating the deal, we're processing everything for the account. If you take a distribution of $5,000, you know, in January, we're going to send you that 1099-R, and it's going to say that on there, and you send that to your CPA, and you use that for tax purposes. When we talk about a solo 401k, not only are you choosing the investment, but you're also doing every other little element that you might not be thinking of as well. So some examples of that are, again, you took the distribution from your account. Are you prepared to generate yourself a 1099? Because you need to. Are you prepared to manage the account? Not only the investments, but also all the inflows and outflows of cash, and do the accounting and the record keeping. And are you also prepared at the end of the year to file the 5,500 that is going to be required for having that type of account? And so for a lot of people, if you are, then a solo 401k can be a great option for you. It's a really powerful account. It's 100% do it yourself. And so for some people, that is a good option, but you've got to be prepared, or be prepared to hire someone that's going to be able to help you to do all the record keeping and the tax reporting and all those sorts of things. The other, from the investment side, comment that I would make on them is, in a self-directed IRA, your custodian, their job is not to vet your deal. So they're not going to be looking at your investment docs and they're like, maybe change this language or think about doing this, because that's not our role in the deal, right? But if we see something that's blatantly prohibited, that's against those disqualified persons or prohibited transaction or investment restriction type of rules, your custodian is going to call that out, and they're going to, say something. In the solo 401k, there's no one there doing that. So the other side of it is, in addition to, like, from a record keeping and a bookkeeping perspective, there's a heavier lift there. In addition to that, you also have to be a lot more well-versed in the IRA specific investment rules, because if you're doing it yourself and no one's looking over your shoulder, if you're not well-versed in it, you might, run into a situation where maybe you did something that was not permissible. And then obviously there's repercussions from a tax standpoint of what those, could look like. So you want to avoid that. So I think a lot of times I see people perhaps eventually look into a solo 401k, like after maybe you get a few deals under your belt. I sometimes see people graduate to it, like, hey, I know the rules, I know what to do now, I really feel equipped to do this, I'm all in on real estate. Maybe then that is a good model for you. But those are just some food for thought. I think they're really good accounts, but they're not for the faint of heart, I guess, is what I'm trying to say.
I will say my both my husband and I have self-directed IRA accounts and solo 401k
Yep.
accounts. Guess who does all the bookkeeping, guys? Right here.
Yep.
My husband goes, I mean, not that he's a brilliant person. Like, what he does, he's a completely brilliant at. But when it gets to the end of the year and he's like, I just got these emails and I don't know what to do with it. I'm like, okay, I could teach you. But then you're not gonna do this again for another 12 months. So let's just
Yeah.
and I already have a bookkeeper. If something happened to me, there is a bookkeeper ready to step in.
Yeah, exactly. Exactly. He's not gonna have to like decode it. So
So,
yeah.
well, one last question, and this is more of
Sure.
a situational question to kind of help us thread everything together. This person said, if I'm buying a multifamily property, say $100,000 investment, outside of the IRA, I'm receiving the neighborhood of 100,000 in write-offs in year one. How can I justify that deduction loss? Then there's also the UBIT issue. In the past, I've only invested the funds through a self-directed IRA. First of all, I'm going to say this is a CPA question.
I
We'll
was
do our
gonna
best.
say that. I was gonna say that, I think that the interesting thing is, we talk a lot about like taxes and strategy and all of those sorts of things. But I think that the other big thing that you need in order to be successful as a CPA that's also like well versed in alts, in real estate, in self-directed IRAs, that can also answer some of these like kind of really specific type of tax standpoint questions. So I would definitely agree, Whitney. Like I would probably defer that question to a CPA that could speak a little bit more in depth about, some of the specifics for that investment.
Yeah, there's a book that I'm working my way through. I heard some people, talk about it recently on podcasts. Let me pull it up because I want to make sure I get the title right for everybody. It is Tax Planning to and Through Early Retirement. Guys, this is dense. This is not for the faint of heart. Dense tax planning book. However, one of the kind of key nuggets in here is if you can, if we're talking about optimizing for taxes, which the tax tail really shouldn't wag the dog, is, but if we're talking pure tax optimization, one of the things they say in the book is in your IRA accounts, self-directed IRA accounts, whatever, the investments that are going to kick off ordinary income that is not tax sheltered, that's a good place to put them. Why? Because
Mhm.
it's in a tax advantage account. Now we can take advantage of the rules of the Roth or the traditional IRA and, maybe doing conversions in later years or utilizing the standard deduction in retirement to unlock that money tax-free or like super low tax. Whereas we would put the equities like this multifamily property. Ideally, if you had the cash, you would hold it cash. Why? Because then you can take the losses to potentially wash income coming in and gains and all that sort of stuff, right? You can we did talk about putting real estate in the self-directed IRA, but we also kind of put some caveats on there. That's if we are purely tax optimizing. However, does not necessarily mean that that is the best strategy for you if what you need is cash flow coming in, right? There might be people that are listening here that we want to flip that paradigm. And so definitely partner with your CPA, right? They're going to go in and they're going to look at your situation to tax optimize it. But when you tell them your goals and what you're trying to achieve at the end, they're going to maybe move some chess pieces around that are counterintuitive to a fully tax optimized plan. Would you agree, Amarie?
Yeah, I would agree. And maybe this is a little counterintuitive if you want to do a specific investment. But I think the other thing I would say is, have you considered doing an investment that doesn't incur UBIT? Because there's plenty of them. There's only a few that do incur it. You're investing into a business, you're buying real estate that, has debt on it, renting out like a personal property, right? So those are some specific examples that incur it. But what about just buying a residential property, buying the property, fixing it up, flipping it? As long as you're not doing too many of those where maybe you're running a business, like that would be fine. That doesn't incur UBIT. Or buying a residential property and being a landlord, like that doesn't incur UBIT. So I think if that is a consideration, and you've got a healthy sum, maybe also consider other opportunities. Maybe lend to an investor, to a company in a manner that doesn't incur UBIT, but where you can still be involved in it. Again, I think Whitney, you said like there's not like one size fits all. There's all these different options that people can be doing in these types of accounts.
Well, Amarie, we are at the top of the hour, and I just want to, say thank you for joining us today and sharing your knowledge with us. And thank you for everybody that joined live and is watching after the fact, not only for spending your time here with us, but investing in yourself. All right. Take care, everybody.
Thanks, guys. Nice to see you.